You pay every single month, every month without fail. Car insurance, health insurance, life insurance, home insurance. You pay and pay and pay. And most of the time, nothing happens. No accidents, no hospital visit, no disaster. So you think, fine, it's a good thing, I don't need it. But here's the question nobody asks out loud. If millions of people are paying every month, and most of them never use it, where does all that money go? Because insurance companies aren't charities. They're not doing this out of kindness. They are some of the most profitable businesses on the planet. In 2023 alone, the global insurance industry collected over $7 trillion in premiums. So let's talk about what's actually happening. Let's follow the money and understand exactly how insurance companies turn your fear into their fortune. Here's the first thing you need to understand. When you pay your monthly premium, that money doesn't just sit in a vault waiting for you to have an accident. Insurance companies take that money and they invest it. They put it in stocks, bonds, real estate, government securities. They let it grow. And here's the brilliant part. They get to use your money right now, while your coverage might never get triggered at all. This is called the float. Warren Buffett, one of the most successful investors in history, has talked about this openly. His company, Berkshire Hathaway, owns major insurance businesses. He's described the float as one of the most powerful financial tools in existence, because insurance companies are essentially borrowing money from their customers for free, and then investing that money to generate massive returns. In 2022, Berkshire Hathaway's insurance float alone was worth over $160 billion. That's not money they earned. That's just the pool of money they were sitting on, yours and millions of people like you. Now, let's talk about the second mechanism. Insurance is, at its core, a numbers game. An insurance company doesn't need to know if you'll have an accident. They just need to know the probability that you will, across millions of people. They hire entire teams of mathematicians called actuaries, whose entire job is to calculate risk. They know, statistically, that out of every 10,000 drivers, roughly this many will crash. Out of every 1,000 homes, roughly this many will flood. Out of every million people with a certain health profile, roughly this many will need surgery. They use that data to set your premium. And here's the key. They always set it higher than the average expected cost. That gap, multiplied across millions of customers, is called the underwriting profit. The entire system is built so that the money coming in is always, by design, more than the money going out. In good years, companies like Allstate, Progressive, and AXA report underwriting profit margins that run into the billions. Now, what about when people actually do make claims? This is where it gets interesting. Insurance companies have entire departments devoted to one thing: minimizing what they pay out. It's not an accusation, it's a business strategy. And it's all completely legal. When you file a claim, an adjuster is assigned to your case. Their job is to assess the damage, but they work for the insurance company, not for you. Studies in the United States have shown that the average insurance payout is often significantly lower than what customers originally expected. Why? Because the fine print matters. Exclusions, deductibles, depreciation formulas, policy limits. All of these are tools that shape how much or how little gets paid. And when companies deny or reduce claims, many people don't appeal. They don't have the time, the knowledge, or the money to fight back. And that silence is very profitable for insurance companies. There's another number that insurance companies track very closely. It's called the lapse rate. This is the percentage of customers who cancel their policy, or simply let it expire, without ever making a claim. In life insurance, studies suggest that a significant portion of term life policies expire without a single claim ever being paid. Think about what that means. Someone paid for 20 years, and then the policy ended, and the company kept everything. Insurance companies know that people forget, get busy, change jobs, or simply assume they don't need the policy anymore, and they quietly count on that. Here's the final piece, and it might be the most powerful one. Insurance companies sell something invisible. They sell peace of mind. And peace of mind is something that people will pay for even when they intellectually know the odds are low. This is called loss aversion in behavioral psychology. Humans are wired to fear loss more than they desire gain. So even if your logical brain says, statistically, I'll probably never need this, your emotional brain says, but what if I do? And that fear, that perfectly human, completely reasonable fear, is the foundation of a multi-trillion-dollar industry. Insurance companies don't just manage risk, they market it. They remind you through advertising, through news coverage, through stories of people who lost everything, that disaster can happen to anyone. And they're not wrong, disasters do happen. But the price of protection and who profits from it is a conversation worth having. So let's bring it all together. Insurance companies make money through four core mechanisms. They collect premiums and invest the float, making billions before a single claim is ever filed. They calculate risk with mathematical precision, always pricing above the expected cost. They minimize payouts through fine print, adjusters, and complex claims process. And they rely on human psychology, on fear, on inertia, and on the policies that quietly expire without ever paying out. None of this is secret, and none of this is illegal. It's simply the architecture of a business built on one of the most primal human emotions, the fear of losing everything. And once you understand how the machine works, you can make smarter decisions. Read your policy, understand your deductible, know what's excluded, and ask yourself, am I buying protection or am I buying someone else's profit? So here's the question I want to leave you with. If you knew exactly how much of your premium was going toward actual protection and how much was going toward someone else's investment portfolio, would you still buy the same policy?